Hi everyone. I have a quick announcement before discussing this week's topic. I've decided to post book chapters on my evidencebasedwealth.com website without using a paywall. I'm going to use a donation model for my book, just as I'm doing for my articles. Now there are a couple of reasons for this. First, I'd like to make my book available, at least in electronic form, even to those who can't afford to pay for it. Second, the donation model has been working out well so far. I'm really impressed with the generosity of viewers who decided to express their gratitude. To all of you who did, please know that I'm very grateful. So far, I have 6 book chapters posted to the website, and I hope you'll all decide to read these chapters and will enjoy them. As always, please feel free to comment in the chat section. I feel like we have a very good community here on this YouTube channel, so we could all have some very meaningful discussions on the website as well. So now on to the topic of the week. So let me go navigate to the article. Give me just a second here. Okay, so this week I explored the topic of deep risk. It's a term which was coined by former neurosurgeon William Bernstein, who has written extensively on the topic of investment risk. Bernstein wrote a book in 2013 where he compared what he called deep risk to shallow risk. In his definition, shallow risk was an annoyance caused by temporary drops in price followed by a recovery, whereas deep risk was a permanent loss of capital. In his words, quote, "Shallow risk, if handled properly, deprives you only of sleep for a while. Deep risk deprives you of sustenance." End quote. His book was an interesting read, but I didn't feel that he offered many helpful insights as he had done in many of his other works. So I took a look at a couple of cases from history just to see what they could teach us. Now the first case that you see here shows the 2-decade-long crash in the Nikkei 225 index as seen through the eyes of a Japanese investor. The Nikkei is a total return index, so it includes the impact of reinvested dividends. I used the Japanese Consumer Price Index to make it so that everything is expressed in June 2021 yen. So this truly reflects what someone in Japan experienced over the past 5 decades in terms of purchasing power. Now, what makes this an example of deep risk? Clearly, the Nikkei has recovered most of its losses from the year 1990. So wouldn't this be an example of shallow risk? Well, that depends upon your personal situation. If you were a relatively young Japanese professional in 1990 and just starting your career, you had lots of time ahead of you to earn and invest. So all of the money that you invested after 1990 has now grown in real purchasing power. That is assuming that you decided not to abandon the Nikkei. But if you were an elderly Japanese person in 1990 and needed to spend from your portfolio to cover living expenses, the mere fact that you needed to sell turns this long grinding crash into an episode of permanent capital loss. Now, moving forward a chart, we can see that a gold-only investor in Japan experienced the same thing. Again, this chart is from the Japanese perspective instead of from the United States perspective. We can again see that this is an episode of deep risk, though it started in the year 1980. From 1980 through 2001, a Japanese gold holder saw the value of their gold decline in a long, slow, grinding way. Gold, in terms of purchasing power in Japan, has recovered, but for the person who needed to sell their gold in the 1980s and 1990s, the bear market created a permanent capital loss. Again, the key here that separates risk from opportunity is whether the capital is being invested in the asset or being pulled from the asset. But what would things have looked like for the Japanese investor who split their wealth evenly between the Nikkei and gold? It turns out that a 50-50 mix would have been a pretty good mix from the standpoint of risk-adjusted return over the past 5 decades. We can see here that mixing gold and the Nikkei not only boosted the mean return from about 3% per year for each of the assets, the Nikkei or the gold in isolation, to over 4% per year for the mix. But it also made the decline much more shallow. So this is an example of using asset allocation to mitigate the devastating impact of deep risk. On this chart, we can see that the decline of the Nikkei had a lesser impact on the retiree because he or she would have had another asset that was performing better. However, I'd argue that it would have been better still to have avoided the Nikkei altogether in 1990. All of the signs that the Nikkei was a bad place to be were there. The price to earnings ratio was about 60, and the dividend yield was less than 1% at the time. So it was a classic case of greater fool theory. So the lesson here is, if you're in an overpriced asset, even if you're diversified and you're about to retire, you better hope that there will be an endless supply of greater fools in your future. Okay, let's move on to what I think is a really interesting case, the United States in the 1970s. Now, Figure 4 here shows the long-term inflation-adjusted performance of the S&P 500. And this is a chart that many equity bugs point to as justification for people being very heavily invested in equities at all times. Time heals all wounds, they say. But this is a little disingenuous. Let's zoom in and see what would have happened to the person retiring in 1968 who was very heavily invested in the S&P 500. So, as we can see here in Figure 5, the U.S. stock investor saw the inflation-adjusted value of their stock holdings, even with dividends reinvested, decline by 50%. And this wasn't a quick decline and recovery like what we saw last year. This was a long and grinding decline. A secular bear, so it would say. For a person who had a long career of saving and investing ahead of them, this created an opportunity. But for the person that had to sell shares to meet living expenses, this created a very real tragedy. It wasn't as bad as it was for the Nikkei investor, but it was still bad. Very bad. But let's see what happens if we add an asset to the mix. Now, most of my subscribers know that I've discovered that a 65% US stock and 35% gold mix has produced a very consistent rate of return over a long period of time. So moving on to Figure 6, we can see that. Look at how consistent the returns were. Now this is a really nice chart, but it still masks what happened in the 1970s. We need to zoom in to see what the inclusion of gold did for the person who retired in the late 1960s. And here is the key chart. Now this one is critical. Notice that the real value of a 65-35 mix started and ended this 15-year period that started at the beginning of 1968 and ended in 1983. It ended at the same level as it started. Now, let me say that one more time because I think it's very important. The 65-35 stock gold mix maintained its purchasing power over this 15-year time period, despite the fact that the stock component dropped by 50%. Now, I bet many of you are thinking that I want to highlight this because it shows how robust the 65-35 portfolio is. Nope, that's not where I'm going with this. In 1968, the S&P 500 had a dividend yield of 3%. And this dividend stream that was paid out over the subsequent 15 years was fairly consistent on an inflation-adjusted basis. So when looking at this chart, we have to realize that what it implies is that the very act of rebalancing during a long price decline of one of the assets in the portfolio actually destroys wealth for the person making withdrawals. I'll say that one more time. So if you have one or more assets in your portfolio that goes into a long decline and you're actually selling some assets in order to meet your living expenses, the very act of rebalancing destroys wealth. So let me put it another way just to make it absolutely clear. A person who had a $1 million 65-35 portfolio heading into retirement in 1968 who decided to spend dividends and not rebalance their assets at all over the subsequent 15 years ended up with more wealth than the person who spent no money and rebalanced. Follow me here. So a $1 million portfolio would have been $650,000 worth of stock and $350,000 worth of gold. The stock component would have produced $19,500 worth of income each year. Without rebalancing, at the end of 15 years, the stock component would have declined to a value of $259,000. The gold component would have increased in value to $1.4 million. Now again, this is in real purchasing power. Thus, the unrebalanced portfolio would have increased in total value from $1 million at the start to $1.67 million in 1983. Meanwhile, it would have produced a dividend income of $19,500 per year that could have been spent. The person who rebalanced and spent nothing from the portfolio would have roughly $1 million at the end of the 15-year period, just as he had at the very beginning. If the person who rebalanced spent the same $19,500, he or she would have ended up with much less than $1 million at the end of this period. So the lesson here is that the act of rebalancing itself during a period of withdrawals can actually destroy wealth when one of the assets in the portfolio is undergoing a period of secular decline. This is completely different than a person who is actually accumulating assets, where the act of rebalancing can be very beneficial. And I think this is a very interesting finding. I'm going to stop this video here and suggest that those who are interested in learning more go to my website and read the article in detail. So thanks for your attention, and I hope everyone has a very nice weekend.